All Things Money with David Blain. A discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain Company in New Bern, here's David Blain.
Hello, I'm David Blain and welcome to All Things Money. For the next 30 minutes, we'll take an educational, stimulating, and hopefully entertaining look at issues affecting your money. The show is about you and your money, so we encourage you to give us a call at 633-0107. That's area code 252. Or email us at allthingsmoney@dlblain.com. That's allthingsmoney@dlblain.com. And we'll be glad to answer your question or address your topic on a future show. Also remember our website, which is www.dlblain.com. We have lots of good information on the website as well as archives of our past shows, so we encourage you to take a look at that. Today we're going to have a little bit of fun with the show. We're going to take a look at some of the stock market myths that continue to pervade, that a lot of brokers and uninformed advisors may promote. And this is a great topic. I happened to read this article. It was in the Wall Street Journal back Monday, July the 26th. So I read it in the journal, and then a couple of clients actually saw it and asked me about it. And then our director of sales and marketing brought it to me and suggested that it would be a good topic for the show. So I've intimately familiar with this article and have been hit with it from several directions. So I think it's a really good topic, and probably a lot of you out there will relate to it as well. So what it is, the title of the article, and by the way, the gentleman that wrote it was Brett Ahrens. And I don't know if Brett got it from somewhere else. I mean, a lot of these, myths that are out there, obviously are not original thought of his, but I don't know if he was the first one to put this together or not. But we'll give Brett at the Wall Street Journal credit for coming up with this top 10 list of things. And so what it is, the list is top 10 myths that just won't die. And his theory is that these are subjects that are promoted by different brokers or advisors or Wall Street that continue to go through and are kind of accepted as fact, but if you take a look at them, you realize that they may not be fact. And that's really what our firm is all about, is looking at the objective data. You'll hear me week after week on this show talking about the objective data, trying to eliminate the noise of the financial markets, eliminating the CNBC, eliminating, a lot of the hype surrounding investments and getting down to the true facts. And I think that's what Brett was trying to do in this article. So we'll start with the first one. You've probably heard this before. This is a good time to invest in the stock market. And we say, really? I've heard this in March of 2000, when the NASDAQ was at all-time high and people thought the internet was going to take over the world, and that companies were going to continue growing and the internet was going to be this all-consuming thing. I've also heard it at the depths of March of 2009, when stocks were just being pummeled, and it was the worst losses, since the 70s or the Great Depression. And the point is that no matter what time it is, certain people on TV or wherever, you always hear, well, this is a good time to invest. And my point about this is that there are certainly, depending on the advisor or the person giving their advice, they may feel it's a good time to invest. My point in pointing this out is, depending on who you're listening to, you're always going to find somebody that's saying it's a good time to invest. Your average broker that is investing in stocks is always going to say it's a good time to invest because they want you to give them their money. So it's not always a good time to invest in the stock market, as we'll see some of these myths as we go forward. A lot of the timing of investing in the market has to do with the valuation that the market is at. That's not to say if you're on a regularly scheduled investment program, there's nothing wrong with investing at all times. It's just we're encouraging you to be skeptical of anyone that promotes that this is the best time to invest in the stock market. There are times when it's better. There are times when it's worse. and we encourage you not to forget about other assets as well. Sometimes is a better time to invest in the bond market or commodities or even cash. So that's one myth that just will not seem to die. The second one is a very important one, that the myth is that stocks on average make you about 10% a year. And this is one that is largely based on the data from around 1928 is when the data for the most data sets that advisors and Wall Street people use. The data set that we have goes back to the late 1920s for the S&P 500. And so this is the data set that most people look to when analyzing stock market returns. A man named Robert Shiller, I believe he's from the Yale School of Business, he went back into the 1800s and was able to get a longer data set, a more time frame, more data points. But this average of 10% a year largely comes from the United States since the 1920s, and it's what you hear all the time. And the reality is that stocks on average have returned that during that period of time. However, in any given year, they almost never return 10%. And that's an important point to remember, that if you wrote down or looked at a list of every return since the 1920s, very rarely, if ever, would you see the return at 10%. It's usually much higher or much lower. The standard deviation, meaning how much the returns vary around that average, is very high, somewhere around 20, which means that the return is hardly ever going to be the average. And that's very important. People hear, well, the average return is supposed to be 10%. Why did I get 2%? Or the next year they get, 15%. But the point is that hardly ever returns 10%. That's also the U.S. experience. There are large periods of time, 10, 20 years, where both in the U.S. as well as overseas, stocks did not return anywhere near an average of 10%. There are time periods where they return more. The U.S. is virtually the only major country in the world to have a stock market that hasn't just completely collapsed. Of course, the Great Depression wiped out a majority of it, but look at the Germans had a developed stock market before World War II. The Japanese had a developed stock market before World War II, and those were completely decimated, absolutely worthless at the end of those time periods. And so when you look around the world beyond the U.S., that statement that stocks return an average of 10% per year becomes even more and more tenuous. So we want you to banish that from your thought. And stocks are a good way to make money, but they are not a reliable source for 10% year in and year out. Well, that brings us to our first break. When we come back, we'll continue talking about some of the myths of the stock market. For All Things Money, I'm David Blain.